Hello, and thank you for watching the Australian Catholic Superannuation's Retirement Planning Seminar video. My name is Justin Colley. I'm the Business Development Manager at the fund.
My name's Tina Tran and I'm one of the financial planners.
So we're going to talk to you today about putting money into superannuation and preparing for retirement and how the allocated pension works. Before we do start though, we're required by law to give you a disclaimer, which essentially says everything today that Tina and I talk about is general information. We're not taking into account any personal circumstances. So should you want personal advice, that's when we suggest that you contact Tina and the team of financial planners at Australian Catholic Super. Australian Catholic Super is an excellent value for money fund. We've had strong performance over the life of our fund. We've been going now for nearly 40 years, and returns for our conservative balance have been over 9%. We have insurance protection for our members, innovative support, we're a values-based fund, and holistic advice. We're an industry superannuation fund providing superannuation for people working for the Catholic Church and for people in the community who share our values. We have $9.5 billion invested on behalf of our 90,000 plus members. What does retirement mean for you? Do you need $1 million to retire? Most people retiring do not have this much money. In fact, the most recent Australian Bureau of Statistics survey data shows at retirement age for men have an average balance of $322,000 compared to women who have $180,000. Many Australians will need to rely on the age pension to supplement their retirement savings. Many people who come and see our fund have different retirement goals. Tina, can you go through some of those goals for us?
Yeah, so when I'm sitting down one-on-one with members, we try and work out what their retirement goals are. And most of it is focusing on what they do, what they want to do in their time. And that could be travelling overseas. Sometimes spending more time with the family is important, looking after the grandchildren. Those two retirement goals have different financial consequences. Travelling is going to probably cost you more, so you need to provision for more in your retirement funds, whereas spending time with your family may not. Other people might have different plans. It could be more lifestyle activities like going to the theatre. Maybe they like the outdoors and spend more time camping. So all of these things need to be considered so you can have a better idea of how much you might need to plan for your retirement.
Yeah, many of our members do have those different goals, and I know I was only talking to one recently who has travelled extensively since they've retired in that 15 years, and he told me that he's been to 85 countries. It made me tired just listening to where all the countries he's been and where he finds time to be spending time in Australia. So, do you have enough money? ASFA, which is the Association of Superannuation Funds of Australia, work out how much you need for a modest lifestyle and a comfortable lifestyle for both a single person and a couple. Now, what they say is for a modest lifestyle, a single person will need just over $28,000, where a couple, a bit over $44,000. We've all been working very hard in our working life and want to strive for that comfortable lifestyle. To have a comfortable lifestyle in retirement, the income you'll need is around $40,500 for a single person and just over $62,000 for a couple.
So with the ASFA modest figures as well as the comfortable figures, what assumptions are built into those numbers? Firstly, it is assuming that you own your own home and you're not paying a mortgage or paying rent. It's also assuming that if you're a couple or a single person, that you don't have any financial dependence. So these figures are just average and they may not be applicable to everybody.
So funding your retirement using super depends on your age. People aged under 59, you can access your superannuation when you genuinely retire. People aged 60 to 64, you can access your superannuation when you leave your employer. You can start a new job, but a condition of release is to leave your employer. People aged 65 and over, you can access your superannuation at any time. People can also qualify for a transition to retirement from age 57 onwards, which we'll talk about a bit later on. So you should be thinking about putting more money into superannuation through salary sacrifice. The government encourages you to be a self-funded retiree and put additional money in by giving you tax concessions. For people who earn between $18,200 and $37,000, your tax rate or your marginal tax rate is 19%. So you're getting a 4% tax saving there. The tax savings are even greater as you earn more money. So if you earn between $37,000 and $90,000, your tax rate or marginal rate is 32%, a tax saving there of 17%. Or a salary over $90,000 to $180,000, your tax rate is 37%, again giving you a tax saving to salary sacrifice of 22%. I'll ask Tina to run through an example.
So we're going to have a look at the benefits of salary sacrificing. If you have a look at the left-hand column of this table, you'll see there's an example of a fortnightly income for someone who's earning an annual salary of $100,000. The first section of the left-hand column, we've got a fortnightly pay of $3,846 a fortnight. This is the gross amount before income tax. Then income tax applicable to that is going to end up with a take-home pay of $2,821. On the right-hand side column, you'll see the example where if you salary sacrifice 5% of your gross pay, you will have a lower taxable income and your take-home pay will also be lower at $2,705. This is a difference of $117 a fortnight. Okay, let's look at the difference. On the right-hand column, you can see by giving up $192 per fortnight, that's 5% of your gross salary, you will have less take-home wage of $117 a fortnight. Now that represents a tax savings of $75 per fortnight. And if you calculate that over a full year, it's $1,950. And multiply that over 10 years, that's $19,500. You can see that the small amount that you put away makes a huge difference over the long term.
So when you salary sacrifice and your employer contributions, the government have limits there on how much you can put in. That's called your concessional contribution limit, and that's $25,000. So again, that is the employer contribution that they put in, which is known as a superannuation guarantee levy, as well as any salary sacrifice contributions are limited to $25,000 per year. When those contributions come in, they are only taxed at 15% as opposed to your marginal rate. There is also non-concessional contributions that you can put into superannuation as well. So non-concessional contributions are your after-tax dollars. So you've already paid tax on this money, so it's not going to be taxed again when it comes into your superannuation account. There are limits there as well. So for people under 65, you can put in $100,000, or you can do what is called the bring forward rule and do 3 years worth at once, so up to $300,000. Once you turn 65 though, you need to meet a work test to put money into superannuation. For our members between 65 and 74, that work test simply says that you work for 40 hours over 30 consecutive days at any time during the financial year. People, once they reach age 75, are no longer able to put money into superannuation. It's also a good idea to consider consolidating your super and bringing all your superannuation together. That way you're not paying duplicate administration fees and it's easy to keep track of and you're only dealing with one fund. How can I access my superannuation? There is two ways. The first way is through a lump sum, where you can cash in the money and invest it yourself and spend it how you like. The second way is through an income stream, which we're going to talk about shortly. When you take an income stream, we're going to pay you your accumulated superannuation. We're going to pay you your income stream as a regular payment into the future, whether you want that on a weekly, fortnightly, monthly, quarterly, 6 monthly or yearly basis. There is flexibility there for you to choose how frequent you want your money paid to you.
So with superannuation, consider it as two phases. The first phase is the working life, where your superannuation account is growing with employer contributions, your own personal contributions in terms of the salary sacrifice or any after-tax lump sum contributions that you might add to your super account. The other amounts that might come in might be lump sum payments that you've received from sale of an asset. That could also be a personal contribution that you make into your superannuation account. While the money is in your superannuation account, it's being invested and it's achieving the investment earnings and any capital growth. One of the advantages of superannuation is that the tax is not at your marginal tax rate, it's taxed within the fund at a low rate of up to 15%. So you've got that money growing in a low tax environment. Now, as you move into retirement, you're able to then transfer that amount that you've built up and create an income stream. We call it an allocated pension. The money that you move into an allocated pension is what I call the second phase of superannuation, where you are receiving a regular payment. The second phase of superannuation is when you move that money and create an income stream. We call that an allocated pension. So with your allocated pension, you can receive a regular payment and you can also draw lump sums from that at any time. And one of the biggest advantages of the superannuation environment is when you're in the allocated pension in retirement, you're getting tax-free earnings and any pension payments is also tax-free. So let's have a look at the process. You've got your contributions going into your superannuation account and your super account is growing nicely. Now you've reached minimum retirement age, that's called the preservation age, and you've got a lump sum in there. You can transfer that amount across to start a transition to retirement allocated pension. That's when you haven't met the full retirement condition, but you've met the minimum age. A transition to retirement allocated pension allows you to receive a pension payment. The pension payment you can receive is a minimum payment of at least 4%, and there is a maximum payment of 10%. So that's 4% of your account balance up to 10% of your account balance. So for example, if you transferred $100,000 across to your transition to retirement allocated pension, you can request a pension payment of $4,000 up to $10,000 per year. With that pension payment, you could use that to either accelerate debt reduction or you could potentially use it to increase your salary sacrifice into superannuation. So these are some of the financial strategies that we're going to consider when we're looking at helping you with financial advice. Now, some of the rules with the transition to retirement allocated pension is that you cannot make lump sum withdrawals, and that's because you haven't met the full retirement condition yet. When you've reached retirement and you've met a condition of release, you can also make lump sum withdrawals, and that is in addition to your regular payment. So some of the conditions that changes when you're at retirement is that you can make a pension payment to yourself of any amount you want, whereas when you're in transition, it's capped at the 10%. Now, there's also tax implications on that pension payment when you are under age 60, and that applies whether it is a transition pension or a retirement pension. Once you're 60 years of age and over, there's no tax on your income from the transition pension or from your retirement pension. So that makes it quite simple, as well as any lump sum withdrawals that you make is also free of tax.
So at Australian Catholic Super, we have two options when you take an income stream. It's our RetireChoice or RetireSmart options. Firstly, our RetireChoice gives you control over your own investment decisions to achieve long-lasting income in retirement. It allows you to choose how your funds are invested, even as you are drawing down on them.
With the RetireChoice allocated pension, you have to make an investment choice, and the available investment options for you are firstly the ready-made options, which is your diversified options, and there are 7 of those that you can choose from. Or you can build your own investment portfolio, and these choices allow you to put the portfolio together by selecting the different assets.
So the second retirement product is RetireSmart. RetireSmart provides members with a convenient mix of investments focused on growing your superannuation savings while providing you with a regular, sustainable income in retirement. It is focused on generating a constant stream of income, making your account balance last as long as possible. We use a 2-bucket investment model that includes a growth bucket and a cash bucket. Tina, can you go through these buckets, please?
So with the RetireSmart, you've got a strategy that is set and forget. Essentially how that works is the cash bucket will form your pension payments of 2 years in regards to how much you've elected to draw out when you set up the account. The balance of the monies will be invested in the growth bucket. And what will happen is that your pension payment will come out of your cash bucket, and the growth bucket will generate the investment returns and be pulled back into the cash bucket. Then there's a rebalancing. So if the investment earnings are higher, your cash bucket can be rebalanced and the monies can be reinvested to the growth bucket. If it's drawing down the cash bucket lower, then there could be a rebalance where there's funds from the growth bucket transferred to top up your cash bucket. So that's happening automatically for you. So what are the tax benefits of saving in superannuation? In the superannuation accumulation phase, you've got a low tax environment. Your investment earnings and any capital growth is taxed at a low rate of up to 15%. When you transfer that money into a retirement allocated pension, there's no tax applicable at all on the investment earnings or on any capital growth, and the pension payment that you receive is also tax-free. So that's as simple as you can get that.
So Tina, what now?
So get a plan done. You don't have to do it alone. That's what we're here for. So we can help you with the financial planning side of things in terms of defining what the goals are and working out the financial strategy that's going to help support you in your retirement. But financial planning for your retirement is not the only thing about planning for retirement. You should also be looking at your health and well-being, and if you have all of that together, it's going to give you a secure retirement and peace of mind.
At Australian Catholic Super, there's different layers of advice we can offer you. First of all is general advice or general information. That is where our call centre, the regional manager team, the business development team can all talk to you and give you factual information about your account and also the fund. Once you want personal advice, whether that's a single topic advice or more comprehensive advice, that's when you talk to the financial planning team, which Tina's part of. Tina, could you go through that?
Okay, so we have 2 levels of advice. With the phone advice service, they're able to give you simple advice over the telephone about limited topics. For example, salary sacrifice, that's contributions into superannuation, insurance, so what level of insurance you should have, and lastly, your investment choice. So they can help you with working out your risk profile. Now, this is phone advice that's tailored to your personal situation, and there's no cost for that. We also have the comprehensive advice service. So with comprehensive advice, that's a face-to-face service, and it's going to cover a lot more topics than the simple advice. So we cover all the matters to do with achieving your financial goals, which might include cash flow management, budgeting, debt reduction, achieving the time frame that you would like for your retirement, and that's done on a face-to-face basis. Now, with our comprehensive advice, because it's covering all the matters, and this also includes advice for your partner, even if they're in a different fund, there is a fee for that. So the initial meeting is at no cost, and it's an opportunity to get an understanding of where you're at. Then the advisor, like myself, can work out what are the relevant advice topics that we can help you with and give you a fixed price quote for that.
Tina and I have covered a few topics today. If you want further information, please contact our call centre on 1300 658 776. They can also assist you in booking a time to see one of our comprehensive planners to talk through your comprehensive plan, or if you're interested in one of those limited advice topics that Tina spoke about, the call centre can help you there as well. There's more information about what we spoke about today at our website as well at catholicsuper.com.au, or you can email us as well at fundoffice@catholicsuper.com.au. Tina and I would like to thank you for listening today and watching this video, and please feel free to contact us at any time. Thank you.
Thank you.